Okay, reading 22, now on financial reporting standards. Learning outcome, the candidate should be able to describe the objectives of financial statements and the importance of financial reporting standards and security analysis and valuations. Describe roles and desirable attributes of financial reporting, standard setting bodies and regulatory authorities in establishing and enforcing reporting standards, and describe the role of international organizations of security commissions. Describe the status of global convergence of accounting standards and ongoing barriers to developing one universally accepted set of financial reporting standards. Describe the International Accounting Standards Board conceptual framework, including the objectives of qualitative characteristics of financial statements, requiring reporting elements and constraints and assumptions in preparing financial statements. Describe general requirements for financial statements under the International Financial Reporting Standards. Compare key concepts of financial reporting standards under the IFRS and U.S. generally accepted under principles of U.S. GAAP reporting systems. Identify characteristics of a coherent financial reporting framework and the barriers to creating such a framework. Describing implications of financial analysts of differing financial reporting systems and the importance of monitoring developments in financial reporting standards. Analyze company disclosures of significant accounting policies. Introductions. Financial reporting standards provides principles for preparing financial reports and determines the type and amount of information that must be provided to users of financial statements, including investors and creditors, so that they may be make informed decisions. This reading focuses on the framework within which these standards are created. Understanding of underlying frameworks of financial reporting standards, which is broader than knowledge of specific accounting rules, will allow an analyst to assess the valuation implications of financial statements, elements, and transactions, including transactions such as those that represent new developments, which are not specifically addressed by standards. Section 2 of this reading discusses the objective of financial statements and the importance of financial reporting standards in security analysis and valuation. Section 3 describes the role of financial reporting setting bodies and regulatory authorities and several of the financial reporting standard setting bodies and regulatory authorities. Section 4 describes the trend towards the barriers of convergence of global financial reporting standards. Section 5 describes the International Financial Reporting System, or IFRS framework, and general requirements for financial statements. Section 6 discusses the characteristic of an effective financial reporting framework, along with some of the barriers to a single coherent framework. Section 7 illustrates some of the specific difference between the IFRS and U.S. generally accepted accounting practices, or U.S. GAAP. And Section 8 discusses the importance of monitoring development in financial reporting standards. A summary of the key points and practice problems in the CFA Institute's multiple choice formats concludes this reading. Objectives of financial reporting. The financial reports of a company includes financial statements and other supplemental disclosure necessary to assess a company's financial positions and periodic financial performance. Financial reporting is based on a simple premise, the International Accounting Standard Board, or IASB, which sets financial reporting standards to have been adopted in many countries. Express it as follows: the conceptual framework of financial reporting 2010. The objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful in existing potential investors, lenders, and other creditors in making decisions about the provider resources to an entity. These decisions involve buying, selling, or holding equity and debt instruments, and providing or setting loans and other forms of credit. The objective of the conceptual framework differs from the objective of the framework for the preparations of presentation of financial statements in 1989 in a number of key ways. The scope of the objective now extends to financial reporting, which is broader than the previously stated scope of covered financial statements only. Another difference is that the objective now specifies the primary use of whom the reports are intended, while the previously stated objective referred solely to a wide range of users. Also, while conceptual frameworks identifies information and should be reported, including that about financial positions, economic resource and claims, changes in economic resource and claims, the financial performance reflected by accrual accounting and past cash flows. It does not list the information within the objective itself, unlike the previously stated objective. Standards and development in accountants with the framework, so it is useful to have an agreed upon framework to guide the development of standards. The joint conceptual framework projects, or the IASB and U.S. Financial Accounting Standard Board aimed to develop common foundations for standards based on these foundations, were to be principle based, internally consistent, and converged. Until recently, financial reporting standards were primarily developed independently by each country's standard setting body. The independent standard setting created a wide range of standards, some of which were quite comprehensive and complex, often considered to be rules based on standards, and others more general, often considered to be principle-based standards. Accounting standards and the economic crisis of 2008 to 2009 increased awareness of the need for high quantity, more uniform global financial reporting standards, and provided the impetus of stronger coordinations among the major standard-setting bodies, such as coordinations. Is also a neutral outgrowth of the increased globalization of capital markets. Developing financial reporting standards is complicated because the underlying economic reality is complicated. The financial transactions, financial positions that companies aim to represent in the financial reporting is also complex. Furthermore, uncertainty about various aspects of the transactions often results in the need for accurately and estimates, both in which necessitate a judgment. Judgment varies from one preparer to the next. Accordingly, standards are needed to achieve the same amounts of consistency in the judgments. Even if such standards there usually will be no single correct answer to the questions of how to reflect economic reality in financial reports. Nevertheless, financial reporting standards try to limit the range of acceptable answers in order to increase consistency in financial reports. The IASB and FASB have developed similar financial reporting frameworks which specify the overall objective and qualities of information to be provided. Financial reports are intended to provide information to many users, including investors, creditors, employees, customers, and others. As a result of multi-purpose nature, financial reports are not designed solely as asset valuations in mind. However, financial reports provide important inputs into the process of valuing a company or are the securities a company issues. Understanding the financial reporting framework, including how and when judgments and estimates can affect the numbers reported, enables an analyst to evaluate the information reported and to use the information appropriately when assessing a company's financial performance. Clearly, such an understanding is also important in assessing the financial impact of business decisions by and making comparisons across entities. Standard setting bodies and regulatory authorities. A distinction must be made between standard-setting bodies and regulatory authorities. Standard-setting bodies, such as the IASB and FASB, are typically private sector, self-regulated organizations and board members who are experienced accountants, auditors, and financial statements users of financial statements, and academics. The requirements to prepare financial reports and accountants with specified accounting standards is the responsibility of regulatory authorities. Regulatory authorities such as the Accounting and Corporate Regulatory Authority in Singapore and Securities and Exchange Commission, the SEC in the United States. The SEC Commission in Brazil has a legal authority to enforce financial reporting requirements and exert other controls over entities with participants in the capital markets within their jurisdiction. In other words, generally, standard-setting bodies and standards of the regulatory authorities recognizes and enforces these standards without the recognition of standards by the regulatory authorities. The private sector standard-setting bodies would have no authority. Note, however, that regulators often retain the legal authority to establish financial reporting standards in a jurisdiction and can overrule private sector standard-setting bodies. This section provides a brief overview of the International Accounting Standards Board of the U.S. Financial Accounting Standard Board. The overview is followed by the descriptions of the International Organization of Securities Commission, the U.S. Securities of Exchange Commission, the Capital Market Regulation of the European Union. The topics covered in this overview, which are chosen the several as examples of standard-setting bodies, securities commissions, and capital markets regulations. After reading these descriptions, the reader should be able to describe the function and roles of standard-setting bodies and regulatory authorities in more detail than is given in the introduction to this section. 3.1 Accounting Standards Board. Accounting Standard Board exists in virtually every nation market. These boards are typically independent, private, not-for-profit organizations. Most users of financial statements know that International Accounting Standards Board issue International Financial Reporting Standards of the U.S. Financial Accounting Standards Board, that the source of the U.S. generally accepted accounting principles. Most countries have an accounting standard setting body that are certain attributes that are typically common in the standard setters, often discussing the IASB and FASB. Some of the common and desirable attributes of accounting standards boards will be identified. International Accounting Standards Board, the IASB, is the independent standard setting body of the IFRS Foundation and the independent not-for-profit private sector organization. The trustee of IFRS Foundation reflects a diversity of geographical and professional backgrounds. The trustees appoints members of the IASB and related entities, ensure the financing of foundation, establish the budget, and monitor the IASB's strategy and effectiveness. The trustees of the foundation are accountable to the monitoring board composed of public authorities and include representatives of the European Commission, the IOSCO, and the Japanese Financial Service Agency, and the US SEC. The chairman of the Basel Committee of the Banking Supervision serves as the observer of the monetary board. The trustees of the IFRS Foundation makes a commitment to act in the public interest. The principles objectives of the IFRS Foundation is to develop and promote the use of adaptation of a single set of highly quantitative financial standards to ensure the standard results as transparent, comparable, decision-useful information while taking into account the need for a range of sizes and types of entities in diverse economic settings and promote convergence of national accounting standards. The IFRS, the trustees are responsible to ensuring the IASB and its perceived independence. Each member of the IASB is expected to exercise independence and judgment in setting standards. As member of IASB are appointed in the trustees on the basis of professional competence and practical experience. As is true for trustees, the member reflect the diversity of geopolitical professional backgrounds. The members deliberates, develop, and issues international financial reporting standards to related entities, which members are appointed by the trustees. The IFRS Interpretation Committee and the IFRS Advisory Council. The Interpretation Committee members are responsible for reviewing accounting issues that arise from application of the IFRS and are non-specifically addressed to the IFRS, and for issuing appropriate authoritative IASB approval interpretations. Note that the authoritative interpretation must be approved by the IASB. If IFRS Advisory Council's members represent a wide range of organizations and individuals that are affected by the interested in international financial reporting, the Council provide advice to the IASB on, among other terms, agenda decisions and priorities. The IASB has been processed that it goes through when deliberating, developing, and issuing international financial reporting standards. A simplified version of the typical process is as follows. An issue is identified as a priority of considerations and placed on the IASB's agendas of consultation with the Advisory Council after considering the issue, which may include soliciting advice from others, including national standard setters. The IASB may publish an exposure draft for public comment. In addition to soliciting public comment, the IASB may hold public hearings and discuss proposed standards. After reviewing the inputs of others, the IASB may issue a new or revised financial reporting standards. These standards are authoritative to the extent that they are recognized and adopted by regulatory authorities. Financial Accounting Standard Board, the FASB, and its predecessor organizations have been issuing financial reporting standards in the United States since the 1930s. The FASB operates within a structure similar to that of the IASB. The Financial Accounting Foundation oversees, administers, and finances the organization. The foundation ensures the independence of standard setting process and appoints members to the FASB and related entities, including the Financial Accounting Standard Advisory Council. The FASB issues new and revised standards to improve standards of financial reporting, so the decisions useful information is provided to users and financial reporters. This is done through done through a thorough and independent process that seeks inputs of shareholders, and it oversees the financial accounting foundation. The steps is the process similar to those described in the IASB, and the outputs of the standard setting process are contained in FASB's accounting standards codification. Effects of periods ending at 15 of September 2009, the codification of the standards and authority of U.S. Generally accepted accounting principles by the applied non-governmental entities. The codification is organized by topic. Among the specific motivations for the codification, the FASB mentions that it will facilitate researching accounting issues, improve the usability of the literature, provides accurate, updated information on the ongoing basis, and help with the convergence efforts. The USGAAP and the establishment of the FASB is officially recognized as authorities by the SEC. However, the SEC retains authority to establish standards, although it has rarely outruled the FASB and the SEC. The SEC does not issue authoritative financial reporting guidelines, including the self-accounting bulletins. The bulletins reflect the SEC's views regarding accounting-related decisions, participants, practices, and could be found on the SEC website. These portions, but not all portions of the SEC regulations, releases, interpretations, and guidances are included in the references of the FASB's codifications. Desirable attributes of accounting standard boards. The responsibilities of all parties involved in the standard setting process includes trustees of a foundation or others to oversee, administer, and finance the organization and members in the standard setting board. Such a clearly defined all parties involved in the standard setting process should observe high professional standards, including standards of ethics and confidentiality. The organization should have adequate authority, resources, and competence to fulfill its responsibilities. The process that guides the organization and the formation of standards should be clear and consistent. The accounting standards board should be guided by well-articulated frameworks with a clearly stated objective. The accounting standards board should operate independently, seeking and considering input from stakeholders, but making decisions that are consistent with the stated objectives of the framework. This decision-making process should not be compromised by the presence of external forces and should not be influenced by self or special interests. The decisions of resulting standards should be public interested and cumulative in the high quality of standards, and should be recognized as adopted regulatory authorities. The requirement to prepare financial reports in accordance to specified accounting standards is the responsibility of regulatory authorities. Regulatory authorities and government entities that have the legal authority to enforce financial reporting requirements and exert other controls over entities and participate in capital markets within the jurisdiction. Regulatory authorities may require the financial reports be prepared in accordance to one specific set of accounting standards, or may specify acceptable accounting standards for which, for example, Switzerland's Swiss-based companies listed on the main board of Swiss Exchange to provide financial statements in accordance with the IFRS or USGAAP or the multinational or multi-international. In registered to Switzerland can use the IFRS, USGAAP, or Swiss GAAP. The International Organization of Securities Commission, or IOSCO, is a not regulatory authority by which the members regulates a significant portion of the world's financial capital markets. Its organization is established objectives, has principles, and guiding securities of capital market regulations. The U.S. SEC is discussed as an example of regulatory authority as aspects of a capital market regulation of the European discussed as illustrating the cooperative approach to regulation. International Organizations of Security Commissions. The IOSCO was formed in 1983 as a successor organization to the Inter-American Regional Association. As of September 2010, the IOSCO has 114 ordinary members, 11 associated members, and 74 affiliated members. Ordinary members of the Securities Commissions are similarly governmented regulated authorities of primary responsibility of security regulating in a country. The member regulates over 90% of the world's financial capital markets. The IOSCO's comprehensive set of objectives and principles security regulation is updated as required in the recognition of international benchmarks for the markets. The principles of security regulations are based on the core objectives of protecting investors, ensuring markets are fair, efficient, and transparent, and reducing systematic risk. IOSCO's principles are grounded in 9 categories, including principles for regulators and enforcement, for auditing and for issuers, among others, within the category principles of issuers. 2 principles relating directly to financial reporting. There should be full, articulate, and timely disclosures of financial results, risk, and other information which is material in investors' decisions. Accounting standards used by issuers to prepare financial statements should be of high international acceptable quality. Historically, regulations and related financial reporting standards were developed within individual countries and were often based on cultural, economic, and political norms of the country. As financial markets have become more global, it has become desirable to establish a comparable financial reporting standard internationally. Ultimately, law and regulation are established by individual jurisdictions, so this is required corporations. Among regulations, under the IOSCO principle deals with the use of self-regulatory organizations. Principle 9 states that where regulatory statements or systems make use of self-regulatory organizations, the exercise same direct oversight as responsibility of the as areas of competence. Such SROs should be subject to oversight of the regulatory and observe standards of fairness and confidentiality with exercise of power and diligence and responsibilities. To ensure consistent application of international financial standards, it is important to have a uniform regulation of enforcement across national borders. The IOSCO assists in attaining uniform regulations as well as cross-border cooperation and combating violations of securities and derivative laws. The Securities of Exchange Commission of the United States of America. The U.S. SEC has primary responsibility in securities market regulations in the United States and according members of the IOSCO. Any company issuing securities of the United States or otherwise involved in U.S. capital markets is subject to the rules and regulations of the SEC. The SEC is one of the oldest and most developed regulatory authorities, originating as a result of the reforms made in the stock market crash of 1929, sometimes referred to simply as the Great Crash. A number of laws affecting reporting companies, brokers, dealers, and other market participants from a financial reporting and analysis perspective. The most significant pieces of legislation for the SEC in the 1930s to the 1935 Act of the Sarbanes-Oxley Act of the 2002s. Security Act of 2000 in 1933, the act specified that financial and significant information that investors must receive when securities are sold, prohibits misinterpretation, and requires the registration of all public insurances and securities. Securities Exchange Act of 1934. This act creates the SEC, gave the SEC authority over all aspects of the securities industries, and empowered the SEC to acquire periodic reporting by companies with publicly traded securities. The Sarbanes-Oxley Act of the 2002s. The Sarbanes-Oxley Act of 2002 acts of the Public Companies Accounting Oversight Board to oversee auditors. The SEC is responsible for carrying out the requirements of the acts over the PCAOB. The act addresses auditors' independence, for example, in prohibiting auditors from providing certain non-auditable services to the companies they audit. The Act strengthens corporate responsibility for financial reporting. For example, it requires the chief executive officer and chief financial officers to certify that the company's financial reports fairly presents the company's consideration. Furthermore, Section 4.4 of the Sarbanes-Oxley Act requires management to report on the effectiveness of the company's internal control over financial reports, and to obtain a report from its external auditors, testing from the management assertion about the effectiveness of the company's internal control. Companies comply with these acts principally through the completion of the submission or filing of standardization of issued by the SEC. There are more than 50 different types of SEC forms that are used to satisfy reporting requirements. This discussion herein will be limited to those forms receiving relevant to financial analysis. In 1993, the SEC began mandating electronic filing that required through from the electronic data gathering, analysis, and retrieving system. As of 2005, the SEC filing are required by made electronically. The EDGAR has made corporate and financial information more readily available to investors and the financial community. Most of the SEC filings of an analyst will be interested by Okay, securities offering registration statements. We've got Form 10K, 20F, and 40F. Annual report, proxy statement forms 10Q, 6K. Okay, so these are examples of the FEC requirements. Furthermore, we also have the Form 8K, the Form 144, Form 145. We have the Form 11K. Okay. Capital markets regulations in Europe. Each individual members of the European Union regulates capital markets in its jurisdiction. There are, however, certain regulations that have been adopted at the EU level. Importantly, in 2002, the EU agreed to form 1st January 2005 consolidated accounts of the EU listed companies with the International Financial Reporting Standard. The endorsement process by which newly issued IFRS are adopted by the EU reflects the balance between the individual member states and autonomy of the needs for the corporate convergence. When the IASB issues a new standard, the European Financial Reporting Advisory Group advises the European Commission on the standard. On the standard advice, a review group provides the Commission an opinion about the advice. Based on the input from these two entities, the Commission prepares a draft endorsement regulation. The Accounting Regulatory Committee votes on the proposal, and if the vote is favorable, the proposal proceeds in the European Parliament and the Council of European Union for approval. Two committees related to securities regulations established in 2001 by the European Commission is the European Securities Commission, the ESC, and the Committee of European Standard Security Regulators, or the CESR. The ESC consists of high-level representatives of member states and advises the European Commission on security policy issues. The CERS or the CSR are independent advisory bodies composed of representatives of regulatory authorities of member states, assist the Commission particularly in the technical issues. As noted earlier, regulation still rests with the individual member states, and therefore requirements for registered states and filing periodic financial reports vary from country to country. On 1st of January 2011, the CERS was replaced by a European Securities and Market Authority, or the ESMA. As part of the reform of the EU Financial Supervisory Framework, the EU Parliament created the ESMA as a EU cross-border supervisor for the CERS's power when demanded insignificant and coordinate supervision of the EU markets. ESMA is one of the European Supervision Authority and two other supervision banking and insurance industries. Convergence of global financial reporting standards activities. Let me drink my tea real fast. So today's drink, okay, I'm drinking green tea, not sweetened and chilled today. I actually don't like putting milk in my tea, whether black or green, or Earl, or breakfast tea. Anyways, convergence of global financial reporting standards activities in the early part of the 21st century has moved the goal from one set of universally accepted financial reporting standards out of the theoretical sphere of closer to reality. The IFRS has been or are in the process of being adopted in many countries. Other countries maintain their own set of standards, but are working with the IASB to converge their standards and IFRS. In some ways, the movement towards the global set of financial reporting standards has made the challenge related to full convergence or adoption of a single set of global standards more apparent. Standard setting bodies and regulators can have different views or use different frameworks for developing standards. This can be a result of differences in international regulatory business and cultural environments. In addition, there may be resistance to change and advocacy for change in certain constitutions. Constituents, accounting bodies may be influenced by strong industrial lobbying groups and others that will be subject to these reporting standards. For example, FASB faced strong opposition in the first attempt to adopt standards requiring companies to expense employee stock compensation plans. The IASB has experienced similar political pressure. The issue of political pressure is compounded when international standards are involved, simply because there are much more interested parties and maybe more divergent views and objectives. In the financial crash of 2008 and 2009, both the FASB and ISAB faced political pressure to amend the standards related to financial instruments accounting. Political pressure and its influence create tensions as the independence of accounting standards boards are questioned and jeopardized. The integrity of financial reporting frameworks depends on the standards of setting's ability to invite the balance of various points of views and yet to remain independent of external pressures. For analysts, it's important to be aware of the pace of change in accounting standards and factors potentially influencing these changes. In addition, issues related to convergence issues of application and enforcement accounting standards unless the standards are applied consistently and enforcement is uniform. A single set of standards may only appear to exist both desirable attributes such as comparable but also lacking. Okay, I'm about to finish my green tea. When I finish, I'll go get another can of my coconut water. I have like 3 more sips of tea. Let me finish it. I'll get my coconut water later. Okay. Okay, so here's an example. Okay. The International Financial Reporting Standard Framework. The conceptual framework for financial reporting in 2010 sets forth the concept for underlie the preparation and presentation of financial statements for external users. The conceptual framework is designed to assist standard settings in development and reviewing standards, to assist preparers of financial statements in applying standards, and in dealing with issues not specifically covered by standards, to assist auditors in forming an opinion of financial statements, and to assist users in interpreting financial statement information. It is important to note that underlying to an understanding of the conceptual framework of 2010 is expected to assist users of financial statements, including financial analysts, in interpreting the information contained therein. The conceptual framework is diagrammed in Exhibit 2. The top part of the diagram shows the objective of general purpose financial reporting at the center. Because other aspects of the framework are based upon the core, the qualitative characteristics of useful financial information surround the objective. The reporting elements are shown next to the elements of financial statements shown in the bottom. Beneath the diagram of the framework are basic constraints or costs and assumptions or governing concerns of the guidelines developed of the standards and preparations of financial reports. Okay, so this is what it looks like. The objective, the quantitative characteristics, the reporting elements. So we can see the relationship between the reporting elements, the objectives, and the quantitative characteristics for the IFRS reporting frameworks in preparation for financial reporting. Constraints. Okay. Objectives of financial reporting. At the core of the conceptual framework is the objective, the provision of the financial information that is useful to current and potential providers of resources in making decisions. All other aspects of the financial flows flow from the central objective. The providers of resources are considered to be the primary user of financial reports and including investors, lenders, and other creditors. The purpose of providing the financial information is to be useful in making decisions about providing resources. Other users may find the financial information useful for making economic decisions. One type of economic decision differed by users, so the specific information needed differs as well. However, although these users may have unique information needs, some information needs are common across all users. Information is needed about the company's financial positions, its resources, and its financial obligations. Information is needed about company's financial performance, as information explains how and why the company's financial positions changed in the past and can be useful in evaluating potential changes in the future. The third common information needed is the conceptual framework diagram and needed information for the company's cash. How did the company obtain cash? How did the company use cash? The conceptual framework indicates that to make decisions about providing resources to a company, users need information that is helpful in assessing future net cash flows to the entity. Such information includes information about the economic resources or of assets and claiming against liabilities and equities. The entity that has and about how well the management and governing board have utilized the resources of entity. It is especially noted that the conceptual framework that users need to consider information from other sources as well as in making their decisions. Further, this is noted that the financial reports do not show the value of an entity but is useful in estimating the value of an entity. Qualitative characteristics of financial reporting, flowing from the central objective of providing information that is useful to providing resources. The conceptual framework elaborates on what constitutes usefulness. It identifies 2 fundamental qualitative characteristics that make financial information useful, relevant, and faithful representation. The conceptual materially is discussed within the context of relevance. Relevance. Here's the definition of relevance. Faithful representation. Here's the definition for faithful representation. Relevance and faithful representation is the fundamental, are the fundamentals, most critical characteristics of a useful financial information. In addition to these fundamental characteristics, the conceptual framework identifies 4 characteristics that enhances the usefulness of relevant and faithfully represented financial information. These enhancing qualitative characteristics are comparably, verifiably, timeless, and understandably too. Comparability allows users to identify and understand similarities and differences of terms. Verifiability means that there are different knowledges and independent observers would agree that the information presented faithfully and represents the economic phenomenon that purports represents. Timeliness. Information is available to decision makers prior to their making of decision. Understandability. Clear and concise presentation of information enhances understandability. The conceptual framework specifies that the information is prepared and shown to be understandable, and the users have a reasonable knowledge of business and economic activities who are willing to study the information with diligence. However, some complex economic phenomena cannot be presented in an easy form. Information that is used should not be excludingly simple because it is difficult to understand. It may be necessary for users to seek assistance to understand information about complex economic phenomenons. Financial information exhibits these quantitative characteristics. Fundamental and enhancing should be useful in making economic decisions. Constraints and financial reports, although it would be ideal for financial statements to exhibit all of these qualitative characteristics and thus achieve maximum usefulness, it may be necessary to make trade-offs across the enhancing characteristics and application of the enhancing characteristics may take priority over others. The aim is an appropriate balance among the enhancing characteristics. A pervasive constraint of the use of financial report is the cost of providing and using information. Optimally, benefits derived from information should exceed the cost of providing and using it. Again, the aim is a balance between cost and benefit. A limitation of financial reporting not specifically mentioned in the conceptual framework involves information not included. Financial statements, by necessity, omit information that is non-quantifiable. For example, the creativity, innovations, and competence of a company's workforce is not directly captured in the financial statement. Similarly, consumer loyalty, a positive corporate culture, environmental responsibilities, and many other aspects about a company may not be directly reflected in the financial statement. Of course, to the extent that these items result in superior financial performance, a company's financial reports will reflect the results. Elements of a financial statement. Let me drink my tea real fast. Financial statements portray the financial effects of transactions and other events by grouping them into broad classes or elements according to their economic characteristics. Three elements of the financial statements directly related to the measurements of financial proportions: assets, liabilities, and equity. Assets are resources controlled by an enterprise as a result of past events and which the future economic benefits from expected to flows to the enterprise. Assets are what a company owns. Liabilities present obligations of a company of enterprises arising from past events, the settlements of which are expected to result in an outflow of resources embodying the economic benefits. Liabilities are what a company owns. Owes, not owns. Equity, asset less liabilities. Equity is residual interest in assets by subtracting the liabilities. So here's income and here's expenses. Two important assumptions underlying financial statements, accrual accounting, and going concerns. These assumptions determine how financial statement elements are recognized and measured. The use of accrual accounting assumes that financial statements should reflect transactions in the past period. when they actually occur, not necessarily when cash movement occurs. For example, accrual accounting specifies that a company reports revenues when they are earned. Going concern refers to the assumption that a company will continue business for the foreseeable future. To illustrate, consider the value of a company's inventory if it assumed that the inventory can be sold over a normal period of time, versus the value of some inventory can be sold versus some number of inventory if it is assumed that the inventory must all be sold in one day or a week. Companies with the intent to liquidate or materially curtail operations will require different information for a fair presentation. In reporting the financial positions of a company that is assumed to be a going concern, it may be appropriate to list assets as some measure of a current value based upon the normal market conditions. However, if a company is expected to cease operations and be liquidated, it may be more appropriate to list such assets at the appropriate liquidation value, namely a value that would be obtained in a forced sale. Recognition of financial statement elements. Recognition means an item is included in the balance sheet or income statement. Recognition occurs. Items meets the definition of elements and specifies the criteria of recognition. A financial statement element, asset, liability, equity, income, and expense, should be recognized in the financial statements if it is probable that any future economic benefit associated with the item will flow to or from the enterprise, and the item has a cost or a value that can be measured by with reliability. Measurements of financial statement elements. Measurements is a process of determining the monetary amount at which the elements of the financial statements are to be recognized and carried in the balance sheet and income statement. The following alternative bases of measurement and use the different degrees of varying combinations of measures as liabilities. The historical cost, the amortized cost, the current cost, the reasonable settlement value, the present value, the fair value. General requirements for financial statements. The conceptual framework provides a basis for establishing standards and elements of financial statements, but it does not address the content on financial statements. Having discussed the conceptual framework, we now address the general requirements for financial statements. International Accounting Standards Number 1, Presentation of Financial Statements, specifies the required financial statements, generally features of financial statements, and structures of the content of financial statements. These general requirements I illustrated in example 3 and described in this section below. So here are the features, the required financial statements, the structure of the content, the general features, and they complement each other. In the following sections, we discuss the required financial statements. The general feature underline the preparations of financial statements and specify structure of content in greater detail. Required financial statements, a statement of financial positions, a balance sheet, a statement of comprehensive income, a single statement of comprehensive income, or two statements, an income statement and a statement of comprehensive income that begins with the profit and loss from the income statement, a statement that of changes in equity, separately showing changes in equity resulting from profit or loss, each item, or of other comprehensive income and the transactions with owners of their capacity as owners. A statement of cash flows and notes comprising of summary of significant accounting policies and other expansionary notes that disclose information required by IFRS not presented elsewhere and that provides information relevant to the understanding of a financial statement. Entities are encouraged to furnish other related financial and non-financial information in addition to these required. Financial statements need to be presented fairly, and financial positions, financial performance, and cash flows as an entity. General features of financial statements. A company that applies IFRS is required to state explicitly in the notes of financial statements that it is in compliance with these standards. Such a statement is only made when a company is in compliance with all requirements of the IFRS. It is extremely rare circumstance a company may deviate from the requirement of IFRS if management concludes that companies with IFRS will result in misleading financial statements. In this case, management must disclose details to the department from the FRAS. The IFRS, IS number 1 specifies number of general features underlying the preparations of financial statements. These features clearly are the conceptual framework. Fair representation, going concerns, actual basis, materially and aggregation, no offsetting, frequency of reporting, comprehensive comparative information, and consistency. Structure and content requirements, IAS number 1 also specifies structures and content of financial statements. These requirements includes the following: classified statement of financial position, the balance sheet, minimum information on the face of financial statement, minimum information in the notes, comparative information. Okay, so here's a minimum required lines of items provided in the financial statement. Convergence of convergence of conceptual framework. One of the joint IISP / FASB projects begun in 2004 aimed to develop and improve common conceptual frameworks. The project was conducted in phases. The board's initial technical work plan included objectives of the qualitative characteristics of financial reporting entities, elements, and measurement of recognition of elements. As of 2010, the objective and qualitative characteristics phase was complete and incorporated in the reading. In late 2010, convergence as put in hold in December 2012, the IASB reactivated the conceptual framework, and as IASB project, as more countries adopt the IFRS, the need to consider other financial reporting systems will be reduced. Additionally, the IASB and FASB are considering frameworks from other jurisdictions and developing their joint framework. Nevertheless, analysts are likely to encounter financial statements that are prepared on the basis other than the IFRS. Although the number of relevance of difference of local GAAP reporting standards or systems is likely to decline, industry-specific financial reports, such as those required for banking or insurance companies, will continue to exist. Differences remain between the IFRS and the US GAAP and affect the framework of general financial reporting requirements. The reading on individual financial statements and specific topics will review in more detailed differences in the IFRS and US GAAP as they apply to specific financial statements and topics. As mentioned earlier, the joint IASB, FASB projects was begun in October 2004 and develop a common conceptual framework. The initial focus was to achieve the convergence of framework and improve particular aspects of the framework, dealing with objectives, qualitative characteristics, elements, and their recognition and measurement. A document 2004 discusses paper presented. The board differences between two frameworks, the difference between IFRS and US GAAP that affect the framework for general financial reporting requirements have been reduced by the agreement by the IASB and FASB on the purpose of the scope of the conceptual framework. The objective of general purpose financial reporting and quantitative characteristic useful financial information. Exhibit 6 summarizes the remaining differences as presented in December 2004 discussion papers. Some of the differences identified in 2004 may no longer apply. Just reading on individual financial statements and specified topics will discuss relevant and more current differences in greater detail. For analysis of financial statements created under the different framework, reconciliation schedules and disclosures regarding the significant differences between the reporting bases were formerly available to a greater extent. For example, the SEC used to require reconciliations from foreign private issuers and do not prepare financial statements in accordance with the US GAAP. The SEC no longer requires conciliations of foreign private issuers to prepare their financial reports in compliance with the IFRS. Such reconciliations can reveal additional information relating to the major judgments, components of the financial statements. In the absence of reconciliation, users of financial statements must be prepared to consider how the use of different reporting standards potentially impact financial reporting. This can have important implications for comparing the performance of companies and securities valuation. I finished drinking my tea. I have to go get coconut water. Give me a second where I'll run to my fridge. I'll be right back. Alright. Continue reading. Okay, so I got my coconut water. Took me 20 seconds for me to reach from my office to my... 20 seconds for me to reach from my office to my mini fridge. But, okay. Alright, so I took a minute break. Got my coconut water. It's chilled. I poured it out in my whiskey cup, but okay, effective financial reporting. Discussion of the characteristics of the effective financial... Ooh, that's strong. Why is the coconut water so strong today? Yeah. An effective framework are the barriers to the creation of such a framework offer additional perspective on financial reporting. Characteristics of an effective financial reporting framework. Any effective financial reporting system needs to be a coherent one. Such as frameworks have several characteristics. Transparency. A framework should enhance the transparency of a company's financial statements. Transparency means that users should be able to see the underlying economics of the business reflected clearly in the company's financial statements. Full disclosures and full fair representation creates transparency. Comprehensiveness. To be comprehensive, a framework should encompass the full spectrum of transactions and have financial consequences. The spectrum includes not only transactions currently occurring, but also new types of transactions as they are developed. So an effective financial reporting framework is based on principles that are universal enough to provide guidance for recording both existing and newly developed transactions. Consistency. An effective framework should ensure reasonable consistency across companies and time periods. In other words, similar transactions should be measured presented in a similar manner, regardless of industry, company size, geography, and other characteristics. Balance against this need for consistency, however, is the need for sufficient flexibility and to allow companies sufficient discretion to report results in accordance with the underlying economic activity. I like my coconut water. It's so good. Although it's kind of expensive, though. A good solid liter could set you back around $7. So yeah, because it's imported. My coconut water is manufactured in Malaysia. I think Malaysia or Indonesia, and I have to package it, ship it. So 1 liter is $7, which is okay, but kind of expensive. Barriers to a single coherent framework. Although effective frameworks all share the characteristics of transparency, comprehensiveness, and consistency, there are some conflicts that create inherent limitations in any financial reporting standard framework. Especially, it is difficult to completely satisfy all the characteristics concurrently. So any framework represented an attempt to balance the relative importance of these characteristics. 3 areas of conflict include valuations, standard setting approach, and measurements. So valuation, standard setting approaches, and measurements. Okay. Comparison of IFRS with alternative reporting system. The adoption of IFRS is as the required financial reporting standard by the EU and other countries have advanced the goal of global convergence. Nevertheless, there are still significant differences in financial reporting and global standards. Arguably, the most critical is the differences between IFRS and US GAAP. After the EU adoption of the IFRS in 2005, a significant number of the world-listed companies used one of the 2 reporting standards. For analyzing financial statements created under different standards, reconciliation schedules and disclosures regarding the significant differences between the reporting bases historically available in some jurisdictions were practically helpful. For example, the SEC historically required reconciliation for foreign private insurers and did not prepare financial statements in accordance with the US GAAP. In 2007, however, the SEC eliminated the reconciliation requirement for companies and prepared their financial statements according to IFRS. Although the disclosures related to any such differences are sometimes dauntingly long, the numerical reconciliation of net income and shareholders' equity appeared in charts with the relatively easy to use. As an example, consider the reconciliation disclosures made by Syngenta AG, a Swiss agribusiness company, in 2006. The last year it was reconciliated were required. But Switzerland isn't in the EU. That kind of messes with me. Anyways. Note that reconciliation disclosures are no longer generally available, and analysts comparing the two companies that uses different reporting standards must be aware of the areas which accounting standards have not been converged. For example, data from 2006 SEC reconciliation indicates that pensions and goodwill were the dominant IFRS to US GAAP reconciliation of European companies. That lists your stocks on the exchange in the United States. In most cases, a user of financial statement prepared under the different accounting standards will no longer have enough information to make specific adjustments required to achieve comparability. Instead, an analyst must maintain general caution in interpreting comparative financial measures and produced under different accounting standards and monitor significant developments in financial reporting standards. Exhibit 8 below discuss the current status of the IASB-FASB convergence projects as at 2017. As mentioned earlier, no new projects are expected to be added to the project. Monitoring development and financial reporting standards. In studying financial reporting and financial statement analysis in general, the analyst must be aware that reporting standards are evolving rapidly. Analysts need to monitor ongoing developments in financial reporting and assess their implication for security analysis and evaluation. The need for monitor developments in financial reporting standards does not mean that standards should be accountants. But analysts should be accountants. An accountant monitors these development from a preparer's perspective, and analyst needs to monitor from a user's perspective. More specifically, analysts needs to know how these developments will affect financial reports. Analysts can remain aware of developments in financial reporting standards by monitoring 3 areas: new products or transactions, actions of standard settings, and other groups represented users of financial statements such as the CFA Institute, and company disclosures regarding critical accounting policies and estimates. New product or type of transactions. New product and new type of transactions can have unusual or unique elements to them, such as no explicit guidelines in the financial reporting standards exists. New products or transactions typically arise from economic events, such as new businesses, or from newly developed financial instruments or financial structures. Financial instruments, whether exchange traded or not, are typically designed to enhance a company's businesses or mitigate inherent risk. However, at time, financial instruments or structured transactions have been developed primarily for purposes of financial reporting, window dressing. Although companies have might discuss new projects and transactions to the financial reports, the analyst could also monitor business journals and capital markets to identify such items. Additionally, when one company in the industry develops a new product or transaction, other companies in the industry often do the same. Once new products, financial instruments, or structured transactions are identified, it helps to gain an understanding of business purposes. If necessary, an analyst can obtain further information from a company's management, which should be able to describe the economic purposes, financial statement reporting, significant estimates, and judgments applied to determining framework described here is useful in evaluating the potential effects on financial statements, even though a standard may not have been issued as to how to report particular transactions. Evolving standards and the role of the CFA Institute. Okay. Company disclosures. A good source of obtaining information regarding the effect of financial reporting standards on the company's financial statements is typically the company itself. This information is provided in the notes of the financial statements and accompanying discussions. Disclosure relating to critical and significant accounting policies. As noted earlier, financial reporting standards need to restrict alternatives but retain flexibility in allowing enterprises to match their accounting methods with underlying economics. As a result, companies choose among alternative processing policies and use estimates. The IFRS and US GAAP companies are required to disclose their accounting policies and estimates in the notes of the financial statements. Companies also discuss in the management commentary those policies that management deems most important. Although many of the policies are discussed in both the management commentary and the notes of the financial statements, there is typically a distinction between the two discussion. The management commentary generally relates to aspects of the accounting policies deemed important by management to understand the financial statements. Particular changes, the MD&A disclosure relates to those policies that require significant judgments and estimates, whereas the notes discusses all accounting policies irrespective of whether judgment was required. Each disclosure has value. In analyzing financial reporting disclosures, the following questions should be addressed. What policies have been discussed? Do the policies appear to cover all the significant balances of the financial statement? Which policies are identified as requiring significant estimates? Have there been any changes in these disclosure forms 1 year to the next? Exhibit 10 summarizes the accounting policies discussed in the management report of sections of Volkswagen's annual report. Accounting policy discussion in Volkswagen's management report. Okay. Exhibit 11 lists the items discussed in the note titled Accounting Policies in Volkswagen's notes to financial statements. Note that far more items are described in the notes of the financial statements as compared to the management's commentary, illustrates the broader disclosure of financial notes. Disclosures regarding changes in accounting policies. Companies must disclose information about changes in accounting policies, such as changes can occur as a result of initially applying a new accounting standard or as a result of company voluntarily changing which policy it uses. In addition, IFRS requires discussion about pending implementation of new standards as the known or estimatable information relevant to assessing the impact of the new standards. These disclosures can alert an analyst to significant changes in reporting financial statements amounts that can affect security valuations. Although each discussion will be different, the conclusion that a company can reach about a new standard not yet implemented includes the standard does not apply, the standard will have no material impact, the management is evaluating the impact, or the impact of adoption is discussed. Clearly, the disclosure indicating the expected impact provides the most meaningful information. In addition, disclosures indicating that the standard does not apply or will not have a material effect is also helpful. However, disclosures indicating that management is still evaluating the impact of a new standard created some uncertainty about whether the change might materially affect the company. Okay. Summary. An awareness of financial reporting underlying financial reports can assist in security, valuation, and other financial analysis. The framework describes the objectives of financial reporting, desirable characteristics of financial reporting, the elements of financial reporting, and underlying assumptions of constraints of financial reporting. And underlying of the framework, which is broader than knowledge of a particular set of rules, offers an analyst a basis for which to infer the proper financial reporting and thus security valuation implications of any financial statement elements or transactions. The reading discusses the conceptual objectives of financial reporting standards, the parties involved in standard setting processes, and how financial reporting standards are converging into one global set of standards. Some key points in the reading summarized below: the objective of financial reporting. The objective of general purpose financial reporting is to provide financial information about the reporting entity and is useful for existing and potential investors, lenders, and creditors in making decisions about providing resources to the entity. These decisions involve buying, selling, or holding equity and debt instruments, and providing or settling loans and other forms of credit. Financial reporting requires policy choices and estimates. These choices and estimates require judgments, which can vary from one preparer to the next. Accordingly, standards are needed to ensure increased consistency to these judgments. Financial reporting standards setting bodies and regulatory authorities, private sector standards setting bodies and regulatory authorities play significant but different roles in the standard setting process. In general, standard setting bodies make the rules and regulatory authorities enforces the rules. However, regulators typically retain legal authority to establish financial reporting standards in their jurisdiction. Convergence of global financial reporting standards, the IASB and the FASB, along with other standard setters, work to achieve convergence of financial reporting standards. Many countries have adopted or permit the use of IFRS, have indicated that they will adopt IFRS in the future, or have indicated that they are working on convergence of the IFRS. Listed companies in many countries are adopting the IFRS. Barriers and challenges to full convergence still exist. The IFRS framework sets forth the concept for underlies the preparation and presentation of financial statements and external users, provides further guidance for the elements from which financial statements are constructed, and discusses the concepts for capital and capital maintenance. The objectives are fair representation and useful information is the center of the conceptual framework. The qualitative characteristic of useful information includes fundamental and enhancing characteristic. Information must exhibit the fundamental characteristics of relevance and faithful representation to be useful. The enhancing characteristics identified are comparably, verifiably, timeless, and understatability. The IFRS framework identifies the following elements of financial statements: asset, liabilities, equity, income, expense, and capital maintenance adjustments. The conceptual framework is constructed based on the underlying assumptions of a curl basis and growing concerns of acknowledges the inherent constraints of benefit versus cost. The IFRS financial statements, IAS, number 1, prescribes that a complete set of financial statement, including a statement of financial position, a statement of comprehensive income, a statement of changes in equity, a flow statement, and notes. The notes include a statement of significant accounting policies and other expansionary information. Financial statements need to reflect certain basic features: fair presentation, going concerns, and accrual basis, maturity and aggregation, no offsetting and consistency. Financial statements must be prepared at least annually and must include comparative information from the previous period. Financial statements must follow certain presentation requirements, including a classified balance sheets, minimum information on the face of the financial statements, and its notes. Characteristic of a coherent financial reporting framework. Effective framework shares 3 characteristics: transparency, comprehensiveness, and consistency. Effective frameworks can, however, differ from an appropriate valuation basis. The basis for standard setting and resolution of conflicts between balances sheets and the income sheet focuses. Comparison of IFRS with alternative reporting systems. The significant number of the world's listed companies report under the FIRS or the US GAAP. In most cases, the users of financial statements will lack the information necessary to make specific adjustments required to achieve comparable between the companies that use IFRS and companies that use US GAAP. Instead, an analyst must maintain general caution in interpreting competitive financial measures produced under different accounting standards and monitor significant developments in financial reporting standards. Monitoring development. Analysts can remain aware of ongoing developers in financial reporting by monitoring three areas: use products or types of transactions, actions of standards setters, regulators, and other groups the company discloses, regarding citation, accounting policies, and estimates. Okay, so that is reading 22. We have finished reading 22. We will continue our CFA level 1 our reading. We'll start study session 7, also on financial reporting and analysis, in our next reading, which will be our reading 23. So I hope to see you guys there, and without further ado, goodbye. Oh, by the way, I've been drinking coconut water a lot recently, although it's really expensive. It's really smooth. It's really good. It's a nice alternative to alcohol, if you may, and it's very nice. I've been enjoying it, and I recommend you guys try some coconut water. Alright, I'll shut up now. Bye-bye.